9 consecutive days. Silver fell for 9 straight sessions, wiped out more than 10% of its value, and then today bounced back to $74 an ounce like nothing happened. But here is what I need you to understand. The bounce is not the story. The story is what was happening underneath the market the entire time the price was falling, and almost nobody in this space is telling you the truth about it. Welcome back. If you are new here, this channel exists for one reason. We take the data that institutional traders actually use, and we show it to you straight. No hype, no agenda, just the numbers and what they mean for your stack. If that is what you are here for, hit subscribe right now, because what I am about to show you today is not something you will find on mainstream financial media. Let me start with the situation on the ground right now. Silver spot is trading at approximately $74 per ounce as of March 25th, 2026. Gold is at approximately $4,568 per ounce. That puts the gold to silver ratio at roughly 62 to 1. Now hold that number in your head, because we are coming back to it. That ratio is one of the most important signals in this entire market right now. Here is what drove the 9-day sell-off. The Federal Reserve held rates at 3.5 to 3.75%. Fed Governor Michael Barr made clear that rates are staying elevated to crush inflation. That sent the dollar higher. And when the dollar moves higher, paper silver gets hit hard. On top of that, you had the US-Iran conflict creating oil price volatility that whipsawed risk sentiment in every direction. Institutional traders who bought silver as momentum in 2025 started unwinding positions. The tourists, as SP Angel Metals analyst Arthur Parrish described them, the generalist funds and systematic hedge funds who chased silver's 135% rally in 2025, they started leaving the trade. But here is what none of the mainstream coverage mentioned. While the paper price was falling for 9 consecutive sessions, the physical market was doing something completely different. Let me say that again so it sinks in. While paper silver was getting hammered, physical buyers were stepping in. Dealer premiums on coins and bars began compressing in the 24 to 72-hour window following Thursday's sharp sell-off, a pattern that historically precedes a surge in bargain-hunting physical demand. The floor was forming in physical silver even while the paper market was still collapsing. Now think about this for a moment. Why would physical buyers rush in while the price is dropping? Because they understand something that paper traders do not. The structural story underneath silver has not changed at all. Not one bit. And that structural story lives in the COMEX data. Let me walk you through the numbers, because this is where it gets genuinely interesting. COMEX registered silver. The silver actually deliverable against futures contracts currently stands at approximately 78.95 million ounces. That number has fallen 67% from the April 2020 peak, when registered inventory was above 300 million ounces, 67% gone, and the pace is not slowing. Over just the past 30 days, registered silver declined 10.8%, 9.6 million ounces withdrawn in a single month. Now I know what some of you are thinking. You have heard the COMEX collapse story before. You have heard it in 2011 and 2021, and every time in between. And I want to be completely honest with you about this, because I think the truth is more nuanced and more interesting than what most channels are telling you. Here is the part that is genuinely alarming. The coverage ratio, the percentage of outstanding paper claims that could actually be satisfied with registered inventory, currently stands at 14%. 14 below 15% is historically considered stress territory, and the paper leverage figure is 7.1 times. That means for every 1 deliverable ounce of physical silver, there are more than 7 paper claims against it. And here is the part that should make every single silver holder take notice. In just the January 2026 delivery cycle alone, which is not even a primary delivery month, COMEX processed between 33 and 40 million ounces of physical delivery demand. That is 7 to 10 times the historical January average. And the March 2026 delivery cycle which is a primary delivery month, saw 52.63 million ounces standing for delivery against just 86 million ounces of registered inventory. That is 61% of all deliverable silver standing for physical delivery in a single contract month. Let me say that again. 61% of deliverable COMEX silver in 1 month. So does that mean COMEX is about to collapse? And here is where I need to be very careful with you, because the answer matters for how you position yourself. COMEX has never defaulted. Not once. Not in the 1980s when the Hunt brothers squeezed it. Not in 2011. Not in 2020. Every time the system came under pressure, CME Group found a way to manage it. They raised margins. They capped positions. They changed the rules. And I want you to understand this, not to discourage you, but to protect you from a specific type of mistake that costs regular investors real money. There is a difference between a system under extreme stress and a system about to catastrophically fail. Right now, we have the first. We may never see the second. And if you are betting your entire financial plan on a COMEX default happening this quarter, you are taking on a risk that has a near zero historical success rate. The people running these exchanges are not sitting back watching passively. They have tools and they will use them. Drop a comment down below, stress or collapse. Tell me which camp you are in right now. I genuinely want to know where the community stands on this. But here is where the narrative gets more interesting than the simple collapse story. And this is the part that I think changes how you should think about silver in 2026. Something is different about this cycle compared to 2011 and 2021. And it is not what most people are saying. It is not the solar panels. It is not the Shanghai premium, although that currently sits at approximately 19%, which tells you demand in China is through the roof. Those are real data points, but they are not the new variable. The new variable is institutional delivery behavior. When delivery demand in a non-primary month like January hits 7 to 10 times historical averages, that is not retail investors deciding they want shiny coins. That is institutional money, commercial users, sovereign entities, private funds, deciding they do not trust the paper system to honor its commitments at a later date. They are pulling metal now because they do not want to be last in line. That is a different type of pressure than anything COMEX has faced in previous cycles. Previous squeezes were driven by speculators trying to corner the market. This one is being driven by end users and institutions who genuinely need the physical metal and genuinely question whether it will be there when they need it. The financial market mechanics analyst Arthur Parrish put it plainly: the tourists are leaving, but the structural buyers are not going anywhere. Central bank accumulation, which drove the first leg of the multi-year gold and silver bull run, has not reversed. The Iran conflict and the frozen Russian asset precedent reinforced sovereign demand for physical reserves held outside Western clearing systems, and the gold to silver ratio tells its own story. At 62 to 1 right now, we are still historically wide of the long-term average, which has oscillated between 15 to 1 at its narrowest and 100 to 1 at its most extreme. If the ratio simply reverts to 50 to 1, not a bullish scenario, just mean reversion, silver at current gold prices would be above $90 per ounce. If it compresses to 40 to 1, you're looking at north of $114. The mathematics are not complicated, and this is not speculation, this is mathematics. Now let me give you something more useful than a single collapse scenario, because the most dangerous thing you can do with silver right now is bet your entire financial future on one outcome. Institutional analysts think in probabilities. Here is how I see the current scenario landscape for silver in 2026. Scenario 1, full COMEX delivery failure. Silver spikes to $150 plus, probability 5 to 10%, and I think that is being generous. Every tool in CME Group's arsenal exists specifically to prevent this: margin hikes, position caps, cash settlement, rule changes. They would do all of it before letting the system break. Could it happen? In theory, but it is not where you should be centering your strategy. Scenario 2, manage squeeze. Prices rise significantly, physical markets tighten, COMEX manages delivery pressure through emergency rule changes and cash settlements. Silver overshoots and corrects to a new higher range, somewhere between $80 and $120. This is the most likely outcome if current stress levels continue to increase. I would put this at 30 to 40% probability. It is very tradable if you understand how to structure your position. Scenario 3, status quo. Silver trades in a range between $50 and $80, gradually grinding higher with the structural deficit as the underlying support. This is actually where most institutional market participants appear to be positioned right now. Call it 35 to 40% probability. Not exciting content, but it is the base case. Scenario 4, deflationary shock. A recession hits, credit tightens, risk assets sell off, and silver gets caught in forced liquidation the way it did in March 2020 when it dropped to $12 per ounce. Even in a structurally bullish market, short-term shocks can destroy you if you are overexposed. I would put this at 10 to 15% probability, not high, but not zero. And if you have no hedge against this scenario, you are taking on more risk than you realize. This is not financial advice. Every individual must assess their own circumstances, risk tolerance, and investment objectives. Based on my analysis of the data, the structural case for silver is real. The COMEX collapse story is overblown, and the truth sits somewhere between those two extremes in a way that is genuinely actionable if you know how to use it. The smartest thing you can do right now is own silver as part of a strategy, not as a single bet. That means some physical for the upside scenario. That means keeping dry powder for the dip scenarios. And that means understanding the difference between paper price action and physical market reality. Because what happened over the past 9 days was paper noise. The structural foundation did not move at all. If you want to go deeper on this, if you want to understand exactly how institutional investors build positions in silver and hedge their downside exposure, drop structure in the comments below, and I will know there is demand for a dedicated video on exactly that. Now let me close with something I want you to really sit with. There are 3 types of people watching this video right now. The first type is scared. They watch silver drop 10% in 9 days and they are questioning everything. The second type is confused. They have heard the collapse story. They have heard the manipulation story and they cannot reconcile the contradictions. The third type understands what is actually happening. They see a stress system, not a broken one. They see a 62 to 1 gold-silver ratio that is historically wide. They see 78 million ounces of registered inventory being drained at record pace, while institutional delivery demand has hit levels never seen before in exchange history. They are not panicking at the paper price. They are watching the physical market. Which type are you? If this gave you a more honest view of where silver actually stands right now, share this with someone in the silver community who needs to hear it. Hit like if you think this kind of data-driven analysis is what more of this space needs. Subscribe and hit the bell if you want to be the first to see the next video, because what is coming in the April delivery cycle may be the most important data event for silver this entire year. Drop your honest silver price target for the end of 2026 in the comments. I will pin the most interesting ones, and I will see you in the next one.